Hello, welcome to this brief session on the psychology of investing. Serious investing involves lots of number crunching. Investors will have to analyze macro as well as micro data. At the macro level, we will have to look at trends in GDP growth, corporate earnings, interest rates, exchange rate, capital flows, and the global macro environment. From the macros, we will have to come to company specific micros, where we will have to look at the earnings of companies, EPS, PE ratio, price to book, cost of capital, return on capital employed, pricing power of companies, and so on and so forth. More often than not, investment involves this number crunching of economic and financial data. But equally important is the psychology of investing. How to overcome some of the emotional bias in investing is important. Therefore, in this talk, I will focus on a few behavioral biases in investing and how these biases can be overcome. A major psychological bias in investing is loss-aversion bias. This is the reluctance to book losses. Booking losses involves pain, and accepting pain is very difficult. The human mind is conditioned to avoid pain. So because of this, investors continue to cling on to many of their wrong investment decisions and stock choices. Many investors come to me seeking my advice on restructuring their portfolios. And when I look at their portfolios, I find stocks like low-grade stocks like JP Associates, Reliance Communications, Suzlon Energy, GVK Power, and such stocks which have been steadily going down over the past several years. Even when the market does well, these stocks go down because they have some problems. But retail investors are reluctant to book their losses in these low-grade stocks, and this involves huge losses. So this is the first emotional bias that investors have to overcome, the reluctance to book losses. As the saying goes, remove your weeds and water the plants. So it is important that you have to remove the weeds in the portfolio, incur the losses associated with booking losses, and move on. Another related bias in investing is the endowment bias. This is related to this reluctance to book losses. Endowment bias is the bias associated with owning something. The psychological studies have shown that people value what they own much more than what they do not own. So you give a higher than real value, higher than deserved value to things that they own. Therefore, if you hold some stocks in the portfolio and the stocks are not good, you attach higher value because of the endowment, because of the fact that you have these stocks in the portfolio. And that is what leads to this loss aversion bias in investing. So this is another bias that has to be overcome, the endowment bias in investing. Another very common emotional bias, wrong behavioral trait is what is called confirmation bias. All of us have some attachment to certain ideas, some ideology. We like those ideas, we like those ideologies, and we embrace them. Those ideologies, ideas would have become totally irrelevant and out of date. And when we hold such ideas, and let us say we read something connected with that, and the reading supports your idea, or you discuss with a friend this particular idea of yours, and the friend agrees with your thinking, that reinforces your bias, that reinforces your idea. This idea can be an ideology, a particular thought, or owning a particular stock. So this confirmation bias again clouds our rational investment thinking, and clouds our investment decisions, leading to suboptimal returns from investment. Yet another major behavioral mistake which investors commit is what is called the herd mentality or bandwagon effect. It is also known as jumping onto the bandwagon effect. A couple of days back, an investor rang me up and asked my opinion on 3 stocks. He asked me, the first stock he mentioned, and asked me, so what do you think about that? I told him I hadn't heard about the stock. He told me that he has already bought the stock and he needs my advice on that. Then I asked him, who are the management of this company? Who are the top people in this company? Who is the management? Because management is very, very important. He told me he doesn't know. Then I asked him, have you looked into the earnings of the company? What is the EPS? What is the PE ratio? Is it fairly valued? He told me he does not know. Then I asked him, then why did you buy that share? He told me he and his friends discussed this stock in their WhatsApp group, and some experts, so-called experts in the group, recommended very strong buying into that stock. A few people gave strong tips on buying the stock, saying that it will double in 6 months, and he bought it. So this is herd mentality. You are not making a rational decision. You are swimming with the crowd. You are moving with the herd. This is a very wrong decision. The investors have lost a huge amount of money by moving with the crowd. History of investment will tell us that the most successful investors are contrarians. They move against the trend. 2 strong emotions in investment are greed and fear. Both have to be avoided. Warren Buffett famously said, be greedy when everyone is panicking, and panic when everybody is greedy. In 2008, when the market was crashing and most investors were panicking, Warren Buffett said, most investors are panicking, I am greedy now, and he started investing in the market hugely. So this herd mentality is a behavioral bias that has to be avoided. Another important trait in retail investment behavior is what can be described as the recency bias. This is particularly relevant now. Large number of new retail investors are coming to the market. Last year alone, in 2021, 3 crore new demat accounts were opened in India. Most of the young investors who are now trading through the new applications, trading apps, who have entered the market recently in the last, let us say, 2 years or so, less than 2 years, they don't have much of an idea about the markets. They don't have a deep understanding of the markets. They have not seen a major correction in the market. They have never experienced a crash in the market like the 2008 crash or the 2000 tech bubble crash. And therefore, they look at the market only from their recent experiences. What happened during the last 1 year, last 1.5 years. This can be very wrong investment. This can lead to very wrong investment decisions. So these are some of the important psychological biases in investing, some emotional errors that investors have to avoid. Therefore, serious investors should go beyond just number crunching and try to avoid these psychological biases in investing. Thank you.